everyone. Welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial on the web at elevationfinancial.com. Thanks for joining me. So buying the dip, let's talk about buying the dip. We're not talking about guacamole. So whenever the markets get choppy, many investors start to ask this question: should I buy the dip? It can make sense intuitively. You know, prices are lower than they were. You could get more shares for less money. It feels like you're buying something on sale. So maybe, but the strategy is more complicated than it sounds. And for most investors, it introduces more risk than it removes when you think of this as a long-term strategy. So here's what you want to understand before you plan out this strategy of waiting for a dip. So let's first talk about what buying the dip actually means. So first of all, buying the dip means purchasing investments at a lower price point with the expectation that prices will recover and rise. So the goal is to take advantage of a temporary decline rather than investing at whatever price the market happens to be sitting at right now. So there are two different versions of this approach, and they're not quite the same thing. So first, let's talk about version one, which is holding cash and waiting for a dip. This is the most aggressive version and one that some people see as a strategy. So let's say you have available money to invest, but you deliberately hold it in cash and wait for the market to drop to a certain level before you buy. You maybe set a threshold such as 10%, 20%, maybe even 50%, and you wait. And this approach is where most people kind of get into trouble with a lot of risk. The second version, which is you're investing cash that was already ready to go, is less problematic. So this is the more passive version. So let's say you already have money set aside to invest, and when you notice the market's down, you decide now's a good time to put it to work, and the dip is a kind of a catalyst, not a condition. So that's much less problematic, and we'll come back to that. So let's talk about the problem with the version of waiting for the right dip. So when people talk about buying the dip as a deliberate strategy, they're usually talking about the first version, which is they're holding on to cash and they're waiting. And this is where the math kind of gets problematic and starts working against you. So the problem is you might never get the dip you're waiting for. So if your strategy depends on waiting for the market to go down a certain percentage, you could get into a lot of trouble with this and really miss out on quite a few opportunities. So markets don't owe you a particular dip at a certain percentage. You know, if your threshold is a 20% drop, for example, you might need a major bear market or crisis to trigger you to buy. So for example, let's say you have a 20% threshold strategy and you started in 2009 and you held it through 2026 and you were waiting along the way for that 20% dip before you invest. If that had been the case, you would have sat in cash the entire 17 years. The market kept climbing and you never saw that 20% drop. And you kept waiting and waiting, and the market kept compounding year after year. Although a few dips along the way, there were a few years where you got close to 20%, but you never actually reached that. But overall, long term, the markets just kept going up. And that's what actually happens when investors set these rigid thresholds and wait for conditions that might never arrive. You miss out on all that growth because you're waiting for this specific condition. Also, even when you get a dip, it might not be a discount. So here's a scenario to think about. So let's say you decide to wait until the market drops 20% before you invest. So while you're waiting, the market doubles, then it pulls back 20%. You see your threshold and you buy. The problem is you're still buying in at roughly 60% above where you started. You didn't buy a discount. You bought at a premium compared to where you would have been if you had just invested that money at the beginning when you had it ready. So a dip is only a discount relative to recent prices. It's not a discount relative to where you had originally been when you had the money to invest. And overall, the difference in returns is smaller than you think. So research has consistently shown that the performance difference between buying at a market low versus dollar cost averaging is minimal. One study looked at a 5-year period and compared 3 approaches: investing at the lowest point of the year, investing at the highest point, and dollar cost averaging throughout. The difference between best case dip buyer and steady dollar cost averaging was less than 1% in annualized returns. So even in the worst case scenario, when you perfectly time every dip, which is impossible, by the way, the reward is pretty marginable, and no one can time every dip perfectly. It's just not realistic. So in general, Dollar cost averaging works better for the vast majority of people. It means investing a fixed amount on a consistent schedule, regardless of what the market is doing. Every month, the same contribution goes in. Some months you buy when prices are high, some months you buy when prices are low. And over time, your average cost per share evens out. The strategy works not because it's mathematically optimal in every scenario, but because it removes the emotion from the decision. There's no waiting period, no second guessing, no threshold to meet. The money just goes in and starts working. The biggest enemy of long-term investment returns is not a bad market. It's unforced errors. It's these decisions that are driven by emotion and kind of distract you from a sound strategy. Dollar cost averaging eliminates the conditions that create those errors because you're just investing like clockwork every month without the emotion part of it. So don't try to be clever. Just try to be consistent. Consistency beats cleverness over a long time horizon more often than not. So when is buying the dip actually okay? So when we talked about those two versions, one, the investor who has cash ready to invest, and the other using the dip as a reason to wait and kind of see it as a strategy to kind of time the dip. The first version is pretty good because maybe the dip is a catalyst to get you to invest. So let's say you've been sitting on cash that is earmarked for investing, and a market pullback gives you the psychological push you need to go ahead and invest it. Yeah, do it. That's a reasonable thing to do. You're not holding out for a specific threshold. You're just using current conditions as a nudge to stop procrastinating. Get it in the market. So whatever moves money from the sidelines into the market sooner tends to be a good thing. So time in the market is more valuable than timing the market. It's kind of a cute phrase we kick around, but it's true. The key distinction is intent. Are you using the dip as a motivation to do something you were already going to do? Or are you using it as a condition that has to be met before you'll invest at all? So the first is a nudge. The second is a strategy. And strategies built around market timing are pretty risky. They rarely deliver what you expect. So bottom line, getting invested as soon as possible is generally ideal, assuming this is money meant for the long term. So whether you dollar cost average it in or you lump sum invest, getting invested early is better than waiting for some hypothetical dip that may or may not occur. So putting a practical system into place looks like this. First, set up automatic monthly contributions to your investment accounts. Recurring contributions are ideal because, again, they just happen automatically without the emotion, and it takes the decision out of your hands. You're just constantly buying no matter what. When you have extra cash available, put it in the market. Don't wait for some specific entry point. Invest it when it fits your financial plan and when you have it. Also, resist the urge to time the market. The research is really clear on this, that very few investors, even professional ones, beat a simple, consistent strategy over long periods. Also, just a caveat here, work with a financial advisor. I'm biased, obviously, but work with someone to help you put a plan together and walk with you to figure out how to develop a process and a system that is not emotional, but is based in practical application that works over a long time period. Markets are always going to have dips. They've always recovered. And your job as an investor is not to predict when those dips are going to occur. Your job is to stay invested, stay consistent, and let time and compounding do the heavy lifting for you over the long term. So, hope that is helpful. As always, you're welcome to reach out. You can find me on the web at elevationfinancial.com. You're welcome to reach out and find me there. And if you want to book a free consultation to learn more about working with me or getting answers to any of these things we talked about, you can do that on my website, which is, again, elevationfinancial.com. Thanks for joining me today. Have a great day. We'll see you next time.